This is the Alhambra Investments monthly macro monitor for December 2018. And since we saw you a month ago, a lot of things, a lot of volatility have gone on. So we're going to bring Joe Calhoun in to talk about it. And Joe, I have to tell you that to start off today, the tariffs have found their way down to me, and I'm not happy about it. Because of the tariffs, Hershey's chocolate prices are going up. So it's hitting my pocket.
Yeah, that's just not good news in any way, shape, or form. I'm not so worried about Hershey. I'm more of a dark chocolate guy, but whatever. I can see where that would be upsetting.
Well, let's just start off talking about tariffs today. We had a little news last week that the Chinese president and President Trump got together for a few minutes, and the tariffs that were going to be imposed in January have been pushed out for 3 months. Does that really matter?
No, not really. I've said all along, I don't think we're going to come to a deal. I hope I'm wrong, but I don't think that's the purpose of these tariffs that we've imposed on China, that this administration has imposed on China. I think it's more of a geopolitical issue. I think that there are certainly elements within the U.S. government that want to try to, quote unquote, contain China's desires to be more influential in the world, and they're doing what they can to stop that, and the tariffs are part of that process. Now, it could be that political expediency from President Trump's viewpoint means that he needs to make a deal. We'll see how that goes. But look, we didn't get any agreements at the G20 meeting in Argentina. I'm pretty sure that she and Trump had a good steak. Although I've heard that President Trump likes his well done with ketchup, so I'm not sure how anyone would ruin a nice Argentine steak with ketchup. But anyway, maybe beside the point. But they did have a steak, and they talked, and what exactly was said, I have no idea. Probably not a whole hell of a lot. I don't think she speaks English, and I'm darn sure that Trump doesn't speak Chinese. So, look, they agreed to talk about something that may happen in the future if they agree. It's just really nothing there.
Nothing really changing then in terms of tariffs, so we'll have to watch that.
Well, look, it's good news that they're not going to impose them on January 1, I suppose. They were supposed to go from 10 to 25% on January 1. So, look, I'll take what I can get. But you got to remember, too, that a big part of the problem with this has been the uncertainty surrounding it. And all this really does is kick that can down the road. We're going to be uncertain for another 3 months. Companies have been putting off capital spending projects and trying to decide what to do with their business going forward and they're not going to make those decisions until they know how this tariff stuff comes out. So in that sense, it may have, just pushed things out. It makes things worse. It just makes people wait longer.
The other thing that has been pushing markets around and a lot of volatility since we did our last report in November is interest rates. And some days it pushes the market up, some days it pushes the market down. Where do you see interest rates at the moment and what the Fed Chairman Jerome Powell is up to?
Well, we've talked about this a little bit in the past. I am becoming a fan of Jerome Powell. I think that he is a much more pragmatic chairman than the last two. The last two were married to their models, so to speak. Especially Chairman Yellen, who was a labor economist and, of course, saw everything about monetary policy she saw through the lens of the labor market. So she believed deeply in things like the Phillips curve, which is fine, except, there's not a whole lot of evidence that the thing actually works. But that didn't seem to bother her. She was sticking to the model anyway. I said in this report that I think that the Jackson Hole speech that Powell gave back in August may be one of the most important ever in the history of the Fed, because he said, I'm not married to these models. Things like R star are these unobservable, incalculable numbers, and I'm not going to be beholden to them or what some model says, that, he's going to observe the real world and go in that direction. Look, it's been a little confusing with interest rates. I hear people, one group of people says, well, interest rates went up and the stock market went down. So, gosh, rising interest rates. Yeah, except when the market goes down, it seems like interest rates are heading the other direction. So, there's a little bit of a dichotomy there between reality and what you hear on CNBC. Look, we talked about this a few months ago, Bob. I said I thought we'd get to 3.25. I thought that was the top end of where we would go in this cycle. Well, lo and behold, we hit 325 and change, and that's as high as we've been so far. Now, look, I don't know. Maybe we're headed higher. I think on a secular basis, ultimately, long term, we have seen the trough in rates, and we probably will see much higher rates. don't think we're going to see that right now.
Well, but you also said that the trend line was at 3.86, and we're doing this a few days after you wrote the report, and that's where we're at today, 386.
2.86.
I'm sorry, you're right.
Yeah. That's the uptrend line. We've been in an uptrend since beginning of this year. We're actually up quite a bit. We started this year around that 230 level. We got up to 3.25, so almost 100 basis points rise this year. There's a trend line. If you look at a trend line, if you care about such things. And trend lines work. Technical analysis works because people think it works, and because other people think it works. It's kind of like Kane's beauty contest, right? He says, it's not enough to figure out who's the prettiest girl in the contest. You got to figure out who everybody else thinks is the prettiest girl in the contest. Same thing with technical analysis. These things work because people think they work, and because other people think that other people think that it works. So this trend line comes in at about 286. So I think we could go back up to that 3.25 level. I don't think that would be out of the question because we're not on the verge of recession. Well, look, the bottom line is this. The economy has slowed somewhat. We've had a flattening yield curve. And what a flattening yield curve means is that the market perceives that future growth is going to be somewhat lower. Doesn't say you're going to have a recession, by the way. Even an inverted yield curve does not say you're going to have a recession. All it really says is that future growth is going to be lower. So when we get a flattening yield curve, we get the 10-year Treasury note yield coming in some. It means inflation expectations have fallen some. Well, oil prices fell off a cliff. It makes perfect sense. Powell, I think, is doing quite a good job in trying to balance things and trying to figure out where to go. He said a month ago, he said we were quite a bit below neutral on rates. And now he says we're just below neutral. I'm not sure what changed his mind, but we can see in this report things like the housing market and so forth. That may be the things giving him pause.
Well, and the housing market's not looking all that good. In fact, construction overall is a worry point.
It has been. I would say this, though. Housing, particularly the new home sales and new home construction, that is the part of the housing market that has the biggest impact on the economy. And we got to be really careful here. In the past, we would look at housing, and housing was such a larger part of the economy, and it meant more when it went down. But I will say, if you go back and look at recessions, past recessions, listen, some of them have a fall in construction, and some of them don't. The 2001, 2002 recession, new home construction continued up through the entire recession. So it's not as good an indicator as people think it is, number one. Number two, in this case, we have spent the entire time since the crisis getting back to the low end of the historic range. We're just up around 1 million units, and it's just not it's just not a big number. The bottom end of this range of new home sales, the fact is we've had no boom, so we're not going to have a bust. So even if new home construction, if housing and construction pulls back some here, it means you get a slower economy. It doesn't necessarily mean recession.
I'm not going to say that there's a euphoria about the economy at large, but a lot of people are saying, hey, economy's doing well, I'm doing better. But the Chicago Fed National Activity Index is telling a different story. Yeah,
look, there are certainly this is I would say an uneven expansion, a very uneven expansion. I think there are certainly some people who are doing better from the tax cuts. And I think that, we shouldn't decry that. It's a good thing. But it has been somewhat uneven. If we look at the economy as a whole, there is still this problem with the lower end of the income scales. They haven't kept up. And because of that, their consumption hasn't kept up and their savings hasn't kept up. And so we have this economy that's growing slightly above trend. CFNAI is at a level that's just, associated with a slightly above trend. If you get to zero on that number, then you're at trend, which we take trend to be somewhere between 2 and 2.5% growth. And we're about 2.9, maybe 3 in the last couple of quarters. But that stuff's wearing off. The third quarter GDP number was not that great. It was a good headline, but it was all about consumption and inventories. And the inventory number in particular, I think, was a little, it's like, well, if they didn't mean to, if they meant to build those inventories because they think sales are going to go up, that's one thing. If they built those inventories because they're afraid tariffs are going to go up, it's a completely different thing. And I think it's more the latter than the former. Anyway, the point is that the economy is growing slightly above trend. It hasn't changed. How many times have we said that, Bob? The last 4 or 5 of these recordings, we've said we're growing slightly above trend. And look, to get to recession, with the CFNAI at a 0.22, I think was the number. I'm not sure. I think that's the 3-month average. At that level, I mean, you got to get a 3-month average of minus 0.75 before you get to recession. So we're not even close to that. But look, it is what it is. We're slightly above trend, and that's all it is. And by the way, slightly above trend, but we're slightly less above trend than we were, say, 6 months ago. That's all. That's all it's changed.
And most of the things we're going to talk about, even though there's some things that may concern us, I've heard you say that there's really nothing that's going to push us into recession right away.
I don't see anything right now. Now, look, we were just having this conversation here in the office. Look, we have a flat yield curve. Difference between the 10-year and the 2-year is, 11 basis points as of yesterday. I think it actually got down to 8 at one point yesterday, but it's flat. It doesn't mean anything except that future growth is going to be somewhat lower. And we're already at a low rate of growth. So here's what that means. All it really means is that it doesn't take as big a thing to push us into recession. It means we're vulnerable to falling into recession. Look, it's a lot easier to knock the economy into recession when you're growing at 1.5% than it is when you're growing at 3.5%. Obviously, you're at 1.5% and some minor thing comes along and knocks you into recession. You're at 3.5%, some minor thing comes along and you have a slowdown for a couple of quarters and you go back to where you were. So that's kind of what we're dealing with right now.
Well, because you're talking about credit spreads, or you're talking about the yield curve, let's talk about credit spreads because we usually look at both of those together. What do you see there?
Yeah, well, credit spreads have widened. There's no doubt about it. Now, they have not widened enough for me to get too concerned, but they have widened. And part of that is because of energy. The last time we had a spread widening back in 2015, 2016, it was almost entirely driven by energy. It was energy and the shale industry implosion, really. We had a lot of companies in that shale space went bankrupt. A lot of them got bought out. Lenders tightened up their standards for lending to these companies and so forth. So the spreads did definitely widen big time last time in that period. What we've got now is an anthill versus that mountain that we got back in 2015 and 16. So they've widened, but it's not worrisome yet. It concerns me. I watch it, but we're not to a level yet that makes me go, you know what, we got to do something.
Well, let's talk specifically about oil because that and credit spreads tend to go together some. In the last 4 to 6 weeks, oil has gone from 73.45 a barrel down to 50-ish. That's a huge fall off. But is there as much concern now as there was back in 14, 15, even as far back as 08? Well,
no, because first of all, our economy has, since the financial crisis, has become, in my opinion, too dependent on high oil prices. It used to be that the U.S. economy was vulnerable to high oil prices because we imported a lot of energy. So when oil prices went up, you had a negative impact on consumption, and it had a negative impact on our current account. And it oftentimes preceded recession. I mean, it's the 1990 recession. We ran oil prices up to $50 or $60. I forget the exact number. It's a long time ago because of the Gulf War. And suddenly we were in recession. And George Herbert Walker Bush, who we just put in the ground this week, unfortunately, was the president at the time. He ended up losing the election because of it. But high oil prices were a negative back then. Now we're at a point where we produce so much oil. We are either the largest or the second largest oil producer in the world now. Because we produce so much, high oil prices are positive for the economy. So when prices fall, it's a negative. But by the way, it's not really a negative overall. For the economy as a whole, it's kind of a wash. If oil prices fall, you have a positive impact on consumption because the vast majority of people in this country are not benefiting from high oil prices. You have a small segment of the economy, or it's a fairly sizable segment of the economy, but a small number of people who are positively impacted by higher prices and negatively impacted by lower prices. when you net it out, if we look at what happened back in 2015, 16, when we had that previous period where had oil prices go from 100 to 30, it really was a wash. The positives offset the negatives. We ended up slightly less growth, and we were fine. This time around, I don't think it'll even have that kind of impact because the companies have been through this once before, and changes were forced on them. The weaker guys got bought out. Production in areas with high cost were shut down. The banks came in and said, look, if you want to borrow money to drill more wells, here's what you got to do. You got to hedge all your production. And so a lot of these companies are hedged on their production out a couple of years. So they can survive for a while at $50. They're not going to make a bunch of money at $50, even in the Permian Basin out in Texas, but they'll survive. Back in 2015, a lot of those guys at 50 went under. So I don't think it'll have as big an impact, but it's going to have an impact. And by the way, I would just say, too, the longer it lasts, the bigger the impact, because the real impact on the economy is the drilling of new wells. And with oil at 50, you're not going to drill a lot of new wells.
I think I know the answer to this, but I'm going to ask you anyway. Qatar said they're leaving OPEC, but then today, I think it was Saudi Arabia said, nah, we're not going to turn the spigot off. Is that any impact at all?
I won't say OPEC is irrelevant, but they're getting there. Listen, Qatar leaving I don't think means all that much. They do produce some crude oil, but the vast majority of their money is coming out of natural gas anyway, so I don't think it really matters all that much. As for Saudi Arabia, I'm not even sure what to say about Saudi Arabia anymore with what's been going on with Khashoggi and so forth, and we've had some hearings in Congress about that, and there's even talk of sanctions on Saudi Arabia, which is kind of hard to fathom at this point. But they've been an ally for so long. I'm not sure how we would go about that. But anyway, I don't want to say they're irrelevant. They do produce a lot of oil in OPEC, but everybody cheats. It's never been that effective an organization to begin with, and it's even that much less effective now because individual members are going, what the hell have you done for me lately? Is this an organization that does anything but benefit Saudi Arabia? Because if not, I'm out of here. So, I don't think it means anything.
Looking at the inventory numbers this time, in fact, looking for the whole year, inventories keep going up, but it seems that there's enough sales to offset the inventory increases. Positive or negative?
Yeah, in general, that's been true. Now, we did say that, the GDP report, the last GDP report, Q3, did have a big component of the growth was in inventories. But sales have kept up in some ways. But look, there's some tariff effect stuff going on here. And it affects not just companies buying things to put in inventory, raw materials that they're going to use to make goods, to make final goods, but it also impacts these tariffs, or the anticipation of higher tariffs impacts consumers too. Look, we don't have to look any further than Japan a few years ago when they raised their consumption tax. We know what happens. Everybody knows when the consumption tax is going to go up. So what do? Well, they buy before the tax goes up. Well, that's common sense. What happens after the tax goes into effect? Its sales fall off. So it's no different now with tariffs. Tariffs are nothing more than a consumption tax. Well, they're a little more than a consumption tax, but they are at least a consumption tax. So we know there has to have been some front running of the, tariffs were scheduled to go up on January 1. There has to have been people buying goods that they felt like they had to buy now because they didn't want to pay the higher price after the tariff. So we are seeing an effect in the inventories and the inventory to sales ratios. We're seeing an impact on sales as well as inventories. So yes, it's evened out. Inventory to sales ratios have stopped falling. I would have liked to have seen them go lower. But they're at kind of at a level that really doesn't mean all that much. They're not real high. They're not real low. They're kind of in the middle. So it's okay. We can live with it, put it that way.
And even though companies aren't sure what's going to happen, do you think there will be some more front running, maybe in the fourth quarter, to try and get ahead of what could happen April of next year?
Well, I think that, depends on what people think is going to happen with these negotiations. Unfortunately, this week, we see what happens when people decide that the negotiations are not going to go well. Stocks and the stock market did not like it very much this week because, quite frankly, it's very confusing. Nobody seems to be able to say with any certainty what was agreed to in Argentina. My contention is nothing. Even people within the administration seem confused. And when you have an administration that's confused, you can believe that companies are going to be confused because they don't know what the hell to do. They're not inside the room. They don't know what Lighthizer and Navarro and Kudlow are seeing. But when Kudlow comes out and one says one thing, and Trump comes out and says something different, and Lighthizer comes out and says something thirdly, people are just confused. They don't know what to do. So will there be front running? Yeah, I think there probably will until some resolution is come to that's final. Until you get something, a deal or no deal, yeah, we're going to have people trying to front run these tariffs, yes.
I think one of the good things in the report was that durable goods orders are up again.
Yeah, look, durable goods orders have been okay. I don't want to characterize them as bad. Listen, I say when we find good things in the economy, we got to highlight it and say, look, that was a good number. The durable goods orders have been pretty good. I will say the last report was a little bit distorted. We've seen the ex-transportation numbers are not as good. In the last report, it was defense aircraft orders that skewed the number on the headline higher. The one prior to that was civilian aircraft. So these aircraft orders tend to be very lumpy. And so we try to back those out by looking at an ex-transportation number. Ex-transportation's okay. It's not great, but it's okay. It's up near the highs for the cycle. Not a bad thing. The one that concerns me is the core capital goods number within that report, which has been negative for a couple of months in a row. Look, if you look at the GDP report, this backs it up. GDP report, we had the vast majority of the gain in GDP in the quarter was in inventories and consumption. Business investment was up a fraction. In the previous quarter, it was up 11.5%. In this quarter, it was up 0.8. That's a fall off in investment in the economy, and that is, in my opinion, a direct result of the tariffs. It may not be all tariffs in that maybe there was some burst of investment activity because of the tax cuts and now it's ending. That's possible. But it's hard to disentangle the tariff effect versus the tax effect. You can't really do that. Look, the one thing I do know is that past recessions, going into them has been created by a lack of investment, and coming out of them is caused or created, the end of the recession is created by an increase in investment. So we watch those numbers very carefully. And right now, yeah, like the durable goods numbers, are near the highs of the cycle. But, if you look at, the absolute dollar figure for core capital goods, they're no higher than they were in 2000. If you consider how much bigger the economy is now and the inflation since then, the fact that the nominal number is no higher is kind of shocking.
Well, let's move into that inflation discussion because I think there have been some days in the market that it's been pushed down because of fear of inflation. But Jerome Powell has said or at least indicated, they may slow down the interest rate hikes.
Well, yeah, it may. I mean, it's one of the things I like about Powell. I think he's very pragmatic. And if he sees a reason to raise rates or to be tighter, then he will. And if he doesn't, he's not. He is also cognizant, I think, of the lag between the time they implement a policy and the effect of it, something he talked about in that same speech. Inflation has come down some. Oil prices primarily are going to pull down the overall CPI number. Now, that's not what they use at the Fed. They use the consumption expenditure. But it doesn't matter. The bottom line is that inflation has come in a little bit here. Look, I don't know how long that's going to last. It kind of depends on what the dollar does to some degree. But the bottom line is this. Inflation expectations have fallen. When the nominal 10-year goes from 3.25 down to 2.86, the vast majority of that move has been a drop in inflation expectations. The TIPS market, real interest rates, really haven't fallen that much. We're still up. Well, we're under 1% again, but we're still up near 1%. We had gotten up to about 1.1. We pulled back some under 1 now, but the vast majority of that drop in interest rates is about inflation expectations, not real growth expectations. That's good news, by the way.
Some of that inflation that we saw was driven because you had more people working, making more money, so more people out buying things. But while unemployment is at the lowest point it's been in a long, long time, you've also got a little uptick in unemployment claims. What does that mean?
Yeah, well, let's back up for a second there, Mr. Williams. This idea that more folks working causes inflation, maybe temporarily, but in general, that's not something we at Alhambra here believe, because we believe that when people go to work, they produce a product, they produce an increased supply, And even if they demand some product or some product over and above what they were demanding before, their productivity should provide enough new supply to cover their own demand. If it doesn't, they shouldn't be working. And by the way, if a lot of those jobs turned out to be government jobs, and I would agree with you wholeheartedly, that too many of these folks going to work for the government is going to cause inflation because they don't generally produce enough to cover their own demand. Having said that, there can be a lag there. There can be a mismatch in that they go to work and don't produce enough initially to cover their own demand. They don't increase supply enough to cover their initial demand. You can get a burst of inflation from that. It's small, though. Having said that, let's go back to the unemployment claims. Yes, unemployment claims have ticked up to 230-something thousand now. That was from down right around 200,000. Look, that's not a good thing, obviously. We don't like to see jobless claims go up, but they still are at a very low level. There's a whole bunch of things going on here that we don't know the whole answer to yet. Look, 231,000, let me just say, that's not the weekly number is not what we really watch. From our viewpoint, what we watch is the 4-week moving average. And what we're looking for as a warning sign is when the 4-week moving average of claims this year is higher than it was last year in the same time. We're not there yet. Not even really close. Having said that, one of the things that I've been concerned about this entire cycle with jobless claims and its usefulness as an indicator is that we don't have the same number of people who are eligible to apply for unemployment benefits as we have in the past. So many people are working as independent contractors, the so-called gig economy, whatever you want to call it. Those people are not employees and they don't pay into an unemployment insurance scheme, and so therefore they're not able to claim unemployment. If they lose their job, whatever gig it is that they have on a temp basis or on a 1099 basis, if they lose it, they don't get to file unemployment. So I'm not sure how that's going to affect things when we go into the next recession. It depends on how big that cohort is, and I'm not sure. I don't think anybody really knows a number that we can put on it and say, hey, jobless claims aren't going to act the same as they have in the past. They're not going to go up as much. That's the only thing I can tell you. I can't give you I think that's true. I don't know a magnitude. I can't put a quantity on it.
Yeah, we'll have to wait and see. It may take some time to figure that one out.
The other thing on unemployment, by the way, that I've been watching that a lot of people don't is the Challenger layoff report. Challenger Gray and Christmas is an employment agency, and what they do is they track large layoffs. Large layoffs so far this year, or of the latest month anyway, is up 150% over last year. I've heard a lot of people say, well, that's Verizon and Wells Fargo. Well, that's true. It is Verizon and Wells Fargo. I don't think that matters. This month it's GM. So, if you get enough of those strung together, suddenly, it's like the old saying about, a million here, a billion there, and pretty soon it's added up to real money. Same thing here. You get layoffs at enough companies and suddenly it adds up to something. So that's something to keep an eye on too.
We haven't had a lot of movement in the dollar since we did our last report, but to me, it looks like the dollar's rallied a little bit. So what are you seeing?
Well, look, dollar moves on these. Remember I said earlier that real interest rates had not come down that much. The dollar really moves on these real interest rate differentials. That's what causes, and what that really is about is growth expectations. So when growth expectations fall here, the dollar tends to fall. When they rise here relative to everywhere else in the world, it tends to rise. Bottom line is the rest of the world has not been in that great a shape. We may not be in great shape, but we're in a hell of a lot better than everybody else. So look, the dollar's in an uptrend, and that's one of those areas where I keep looking at it and going, got that one wrong. Look, you can't be right about everything. I keep thinking the dollar should go down, and I think for a variety of reasons it should. It's overvalued on a purchasing power parity basis. The Trump administration has favored a weak dollar from the beginning and continues to. I think there's a lot of reasons why it should go down, but it hasn't. And until it does, we'll acknowledge that and say that it's going up. You're right, though. If you look over the last couple of years, we're really pretty much where we were. So not a whole lot's changed.
And last thing today, let's talk about gold and commodities.
Well, gold has been on the rise here the last few weeks because of concerns about various other things. Gold's that asset that everybody wants to own when things are terrible or when they're worried about things being terrible. And so they have bought gold. Commodities, the commodity indexes, the Goldman Sachs index has gotten hit hard. because it's overweight to crude oil, and crude oil has gotten hit hard. If you look at the Bloomberg Commodity Index, which is more evenly divided among various commodities, it hasn't fallen as much. It's down some, but it's really not that big a deal. Look, we believe that, as I said earlier, I think that interest rates on a secular long-term basis have probably seen their trough. You know, at the depths of things with that slowdown in 2015 and 16, we got down to 1.3% on the 10-year note. Now we're at 286. We've been up to 3.25. I think that 1.3 is probably going to prove to be the low. That also means that inflation's probably also seen its low. I don't know how long this is going to take to play out. If you go back and look at it, these changes, these secular changes take a long time to occur. Decades. We're not talking, you know, something that's going to happen over weeks or months. It's going to happen over years. So ultimately, I do think that we're sitting at a secular bottom in commodity prices, probably gold prices too. Gold is a commodity, but it's a unique one. You tend to see gold do really well if the dollar's weak and the economy's weak at the same time. If you have a fairly strong economy and a weak dollar, then regular general commodities do better. But in either case, a weak dollar is required for these things to go up very much, which is why they're not up much now. They're off their lows from a few years ago. I think we've seen the secular low, but for them to really accelerate to the upside, you're going to need to see the dollar fall, and we just haven't seen that yet. But I am somewhat impressed by their resiliency, especially with gold in the general commodity index, the Bloomberg index. But look, you know, it also says right now, those commodity prices, even though they come off their lows, they're still pretty darn low. Copper prices in particular and crude oil prices have been extremely weak. And both of those point to lower bond yields, at least for now. Until the copper to gold ratio turns higher, until crude oil turns higher, there's probably not going to be a lot of pressure for rates to go up. And that tells you kind of what you need to know.
Well, I'll give you another 30 days to sort all this out, and we'll do it again sometime right after Christmas or in the new year.
I will solve all the world's problems by January 1. Oh, maybe not.
All right, we'll give you till January 2nd.
Everybody have a good holiday, and I'll say something I'm not supposed to say, which is Merry Christmas and Happy Hanukkah, because that already started. And so we'll see you after the holidays.
Thanks, Joe. And if you'd like to see the entire report from Joe, here's the address. And we'll look forward to seeing you when we come back with our report for January.